Let me take you back, way back, to a moment that stuck with me for more than 30 years. Picture this. I'm squeezed into a tiny office with Mr. Kowalski, an old man with stories for days. He'd survived the Great Depression, made it through World War II, and somehow managed to raise a family during the wild inflation of the 1970s. He came in and hit me with a question that sounded simple, but it's never really left me. He said, "Michael, I've seen currencies disappear, banks collapse, governments come and go. Through all of it, gold's never let me down. But my grandkids say I'm stuck in the past. They call gold a relic. Who's right?" That question has haunted me ever since. It gets right to the core of how we think about wealth and what really holds value. I'm Michael, and tonight on Investor Voice, we're going to dig into that question together. We'll talk about gold, sure, and silver too. Not as some magic treasure, but as real, practical financial assets, things that have mattered to people for thousands of years and still do. So here's the big question. Why gold? Why silver? Why did basically every civilization, from the pharaohs to modern America, treasure these metals? The answer is actually kind of fascinating. Gold is rare. All the gold ever mined would fit into just 3 Olympic-sized swimming pools. That's it. Scarcity drives its value. If gold were as common as iron, it'd be as cheap as iron, and nobody would care. Gold is also pretty much indestructible. It doesn't rust, doesn't tarnish, doesn't corrode. You could dig up a gold coin from ancient Rome, and it would still gleam like the day it was minted. That makes gold perfect for passing down through generations. It holds up. It's easy to carry. You can move a lot of value in a small package, and you can break it up into smaller pieces without ruining what makes it valuable. Add its natural beauty, and gold just makes sense as money. That's why people have used it as currency for most of human history. Silver's similar, but it brings something else to the table. Even back in ancient times, people used silver for more than just coins or jewelry. They put it to work. Fast forward to today, and silver's industrial uses have exploded, making it a whole different animal as an asset. I want to walk you through each metal one at a time. Once you see how they work on their own, you'll start to see where they fit in a smart investment strategy. Let's start with gold, the heavyweight. Gold's place in the world's financial system is complicated, and honestly, a lot of people get it wrong. It's not just another investment, like a stock or a bond. Gold is something else. It's a store of value. It's a hedge. It's financial insurance. Central banks everywhere keep huge gold reserves. The U.S. has more gold than anyone, over 8,000 metric tons. Germany's got thousands of tons too. Even countries you might not expect, like China and Russia, have been piling on gold in recent years. Why? Because gold doesn't belong to any one country. It's neutral, not tied to a single economy or political system. When you hold US dollars, you're betting on America. When you hold gold, you're betting on something deeper, on the plain fact that gold's held value for thousands of years, and honestly, probably will for thousands more. Here's something most people miss. Gold doesn't always move the way you think, especially with inflation. Over the really long haul, gold keeps its purchasing power. But in the short run, it can swing all over the place. Look back at the 1970s. Inflation was out of control, and gold went through the roof, from about $35 an ounce to over $800 by 1980. If you held gold then, you made a killing. But then came the 80s and 90s. Inflation cooled off, interest rates stayed high, and gold tanked. By 2000, it was down to about $250 an ounce, a drop of nearly 70% from its peak. If you'd bought gold at the top in 1980, you had to wait over 25 years just to break even. That's a tough lesson. Gold isn't some quick win. It's a long-term play, a store of value for the patient. Like anything else, it has its ups and downs. What really moves gold prices? There's a lot going on, but the big one is real interest rates. If you adjust for inflation and interest rates are low, gold looks a lot better. Cash and bonds just aren't paying enough, so people turn to gold. But when those real rates climb, gold struggles. Suddenly, other investments start to look more appealing because they actually pay you something. Geopolitical chaos matters too. When the world feels shaky, wars, political turmoil, the whole thing, investors flock to gold. It's the classic safe haven. Lately, you've seen central banks, especially across Asia, Africa, and South America, piling into gold. They're moving some of their reserves away from US dollars, just in case things get messy. You can't ignore currencies either. Since gold trades in dollars, a weak US dollar makes gold cheaper for everyone else. That boosts demand and pushes prices up. Flip it around. When the dollar's strong, gold gets more expensive for buyers using other currencies, and demand drops. Silver's a different animal. People call it gold's wild cousin for a reason. It's more volatile, and it's got its own thing going on. The big difference? Industrial demand. Gold mostly sits in vaults or gets turned into jewelry. Silver, though, is everywhere. Electronics, solar panels, medical devices. It's the best electrical conductor out there, and it even has antibacterial properties. Because of this industrial side, silver is a split personality. It's both an investment metal and a workhorse in manufacturing. So, its price reacts not just to investor moods, but to what's happening in global industry and tech. Here's something important. Silver's been in a supply deficit for years. Demand keeps beating supply. Why? Industrial use is booming. Think solar panels, electric cars, data centers. But mine production hasn't kept up. And most silver doesn't come from silver mines. It's a byproduct of mining things like copper or zinc. You can't just decide to dig up more silver when prices spike, since it depends on the output of other metals. That bottleneck makes price swings sharper. Solar is huge for silver. Every panel needs silver paste for its circuits, and as the world ramps up solar capacity, that demand just keeps rising, even though manufacturers are working hard to use less silver per panel. Electric vehicles are another driver. They use much more silver than regular cars, thanks to their complex electrical systems and all the charging gear. As more people buy EVs, silver demand only goes higher. And don't forget data centers, the backbone of the internet and AI. They're packed with servers, power units, networking gear, all stuffed with silver to keep the electricity flowing. All this industrial demand stacks on top of investment demand. When people get excited about precious metals, silver often outruns gold because its smaller market can move faster and harder. People call it gold on steroids for a reason. In boom times, silver can soar way past gold. But there's a flip side. Silver's swings cut both ways. When investors lose interest in precious metals, silver tends to crash harder than gold. Plus, because so much of its demand is industrial, it's sensitive to the economy. If manufacturing slows down, silver prices can take a hit. Now, platinum and palladium, these don't get much attention, but they're crucial. Most of their demand comes from car makers. They're used in catalytic converters to cut vehicle emissions. Platinum also finds its way into jewelry, chemical processing, even some medical devices. Palladium's become more important lately, especially as the world moves away from diesel and toward gasoline cars, which rely on palladium-rich converters. One more thing. Almost all the world's platinum and palladium come from just two places, South Africa and Russia. That's a risky setup. Any political trouble in South Africa or sanctions on Russia can mess with supply and send prices through the roof. Palladium's had a wild ride lately, even topping gold at times. Most of that came down to car makers snapping up the metal as emissions rules got tougher, while big producers struggled to keep up with demand. But nothing stays the same for long in these markets. Electric vehicles are catching on fast, and since they don't need catalytic converters, that's bad news for both platinum and palladium. On top of that, automakers keep finding ways to use less of these metals in each car to save money, so demand could keep dropping. Now, say you want to invest in precious metals. How do you actually do it? There's more than one way to get started, and each has its pros and cons. The most straightforward way is to buy the physical stuff: gold bars, silver coins, platinum ingots, you name it. A lot of people like the feeling of holding a real, tangible asset that isn't tied to any bank or government. It's simple. You own it, and no one else has a claim on it. Physical metal means you're not relying on anyone else. If a bank fails or a fund goes belly up, you've still got your metal. But there are headaches too. You have to figure out where to keep it safe. Maybe you stash it in a home safe, which has its own risks, or you rent a safe deposit box at a bank, which isn't free and can be a pain to access. Then there's insurance, which is another cost. If you're holding a lot, you'll probably want to use a professional storage vault. Those places are secure and insured, but they charge fees. Plus, you need to make sure your metal is allocated, meaning specific bars are set aside for you, not just a claim on a big pile of metal. Another easy way in is through exchange-traded funds, ETFs, that hold precious metals. These trade like regular stocks, so you can buy or sell them in seconds whenever the market's open. No storage worries, no insurance hassles. They're super liquid and accessible. But ETFs aren't perfect. You don't own the metal itself. You own shares in a trust that holds the metal. If something goes wrong with the trust or its custodian, you're exposed to that risk. It's a trade-off. A lot of folks also buy shares in mining companies. This gives you a different kind of exposure. Sure, mining stocks rise and fall with metal prices, but things like management, production costs, and politics matter too. A smart, well-run mining company can beat metal prices. A poorly run one can lag, even if metal prices are rising. Mining stocks might pay dividends and offer growth, which the metal itself doesn't. But they're riskier and tend to swing more than the metals. There are also futures and options. Honestly, these are complicated and risky. Best left to people who really know what they're doing. So how much of your portfolio should go into precious metals? There's no magic number. It depends on your goals, your timeline, how much risk you're comfortable with, and your overall financial picture. Most financial advisors recommend keeping it modest, somewhere between 5 and 10% of your total investments. That's usually enough to help you diversify and protect against really bad events, but not so much that you'll regret it if metals have a rough stretch. Of course, if you're especially worried about inflation or the financial system, you might want more. On the other hand, if you're young and focused on long-term growth, you might skip metals altogether and stick with stocks. The bottom line? Treat precious metals as just one piece of your portfolio, not the whole thing. They can help balance things out, but they shouldn't take over. One thing I've noticed, after years watching investors come and go, the folks who do best with precious metals are the ones who keep a long-term mindset. They buy, they hold, they don't freak out when prices drop, and they don't get greedy when prices soar. They see metals as insurance, not a ticket to quick riches. And that seems to make all the difference. I've watched investors fall into two big traps. First, they buy when prices are soaring, caught up in the excitement and afraid to miss out. Then, when things turn ugly and their investments lag for a while, they panic and sell at the worst possible moment, usually right before things turn around. What really matters is having a plan and actually sticking to it. Figure out the right mix of investments for yourself. Check in from time to time and rebalance. Sell a little when metals have surged. Pick up more when they've lagged. Don't let every little price swing mess with your head. Now, let's talk about the usual knocks against precious metals. I think it's worth seeing both sides. Critics are quick to point out that gold doesn't pay dividends or interest. They're right. Gold just sits there. It doesn't spit out cash like a stock or bond does. Its value is only what someone else is willing to pay down the road. They'll also remind you of the bad stretches, like the 1980s and 1990s, when gold's price kept falling while the stock market took off. Anyone holding just gold back then missed out on some big gains. And the story that gold always protects you from inflation, that's not the whole truth. Sure, gold has kept its value over centuries, but in the short term, the link between gold and inflation is pretty shaky. Sometimes gold does great when prices rise, other times, not so much. These criticisms are all fair. Precious metals aren't perfect, and they shouldn't be your only investment. Think of them as a piece of the puzzle, not the whole thing. But here's what the critics forget. Precious metals have some unique qualities. They're not tied to anyone else's debts or promises. They aren't dependent on a company's profits or a government's stability. Gold is real. You can hold it in your hand, and people recognize its value everywhere. Look at 2008. The financial system was cracking. Stocks were getting hammered. Even money market funds were under threat. Gold not only held up, it went up. Investors with a little gold in their portfolios took a smaller hit than those who went all in on stocks. And when currencies fall apart, when paper money starts losing value fast, gold has been a lifesaver for people from Latin America to Asia and Europe. This isn't just theory. It's happened over and over again. So what's the takeaway? Gold and other metals aren't magic. They won't save you from every risk, and they can't replace a solid investment plan. But they do have a place. They can help protect against those rare, gut-wrenching shocks in the market. They can help defend against runaway inflation and currency problems over the long haul. And they don't always move in sync with stocks and bonds, which helps smooth out the ride. For most people, having a slice, maybe 5 to 10% of their portfolio in precious metals, and holding it steady through thick and thin just makes sense. But here's the biggest lesson I've picked up after all these years. Whatever you invest in, gold, stocks, bonds, anything, know what you own and why you own it. Don't buy gold because some talking head says you should. Don't ignore it just because the crowd is cold on it right now. Take the time to really understand what it does, what it doesn't do, and how it fits into your bigger plan. That's what we aim for at Investor Voice. We try to see things clearly and act on knowledge, not fear or hype. I still remember Mr. Kowalski, the older gentleman I mentioned earlier. He wasn't an expert. He didn't care about fancy strategies or complicated financial products. But he knew one important thing. Some things hold their value no matter what, across decades, governments, and entire eras. And he wanted his grandkids to learn that too. Honestly, I can't say for sure if gold's going to be the top investment over the next decade. Will it beat stocks, bonds, or real estate? I have no idea. But here's what I do know. After thousands of years, gold's still around. People still value it. It still matters. That means something. Thanks for hanging out with me on Investor Voice. I know you could be spending your evening a million other ways, so it really does mean a lot that you're here. If you got something out of this talk, I'd love for you to do two quick things. First, share this video with someone who might need it. Maybe it's a friend who's curious about gold and doesn't know where to begin. Maybe you've got a family member worried about inflation, looking for ways to protect what they've saved. Or maybe you just know someone who likes digging into big questions. Sharing this might actually help them more than you think. Second, if you haven't subscribed yet, go ahead and hit that button. Join the Investor Voice crew. Tap the bell too so you never miss a chance to jump in on these conversations. We're growing every day, and I'm honestly grateful you're even thinking about being a part of it. Drop a comment and tell me what's on your mind. Do you own gold or silver? How do you weave precious metals into your portfolio? Got any questions you want answered? I read every single comment. This back and forth matters to me. That's it for now. I'm Michael, and this is Investor Voice. Remember, the most important thing you'll ever invest in is your own understanding. Take care of yourselves, look out for each other, and I'll catch you next time.